Good morning and welcome to the Gold, Goats, and Guns podcast. My name is Tom Luongo. We've got a lot to talk about. And today I'm going to talk about a lot of things with David Stockman, former director of the Office of Management and Budget for the Reagan administration and publisher of Contra and all around just fantastic gadfly on the markets and politics. So I'm just going to do this quick and get right to it. So good morning, David. Thank you for doing this. I appreciate your time.
Oh, good morning, Tom, and happy to do it. And couldn't be a better time. There's so damn much to talk about that doesn't make any sense. And I guess that's what you and I are both about, trying to make sense out of what is the insensible, I guess.
I like to say it's trying to make sense of a world going completely mad. So let's get started. So Trump, Iran, the killing of Soleimani, the response by them, it's all almost surreal. And the more we hear about this stuff and the more that comes out, the less settled I am on an explanation of what actually happened and what's going on. But I want to get your thoughts on that initially, and then we'll move on from there. And this is, again, will just be a kind of an open, back and forth conversation. I don't really have questions planned or anything along those lines. So, but give me your initial thoughts on what you think is going on with Iran and Trump and the impeachment, and then we'll go from there.
Well, on the assassination, the cranking up of the confrontation with Iran, I think it's just given stupidity a new name. But I think we need to dig into it a little bit and recognize that it's probably even in some ways more dangerous than it appears, given the fact that tensions cooled down dramatically when the Iranians were smart enough to send a 22 missile fire drill that hit some fuel tanks and a hangar or something, but no people. Because here's the thing, Trump's instincts are pretty good when it comes to foreign policy. He said he wanted America first. He wanted to end regime change wars. He wanted the rest of the world to be co-responsible, so to speak, for what goes on in the global system. And yet his temperament or emotion controls are terrible. And worse still, his choice of personnel is absolutely rotten. From day one, the guys surrounded themselves with basically neocons, warmongers, warfare state careerists, and that goes back to McMaster's and Mattis. But now, how in the world, after everything that he said he wanted to do, did he pick Bolton? And then when he finally got rid of Bolton, he started listening to Pompeo, who I think is the worst of all. The guy is really, some kind of extreme neocon evangelist who is actually an evangelical, apparently waiting for the rapture. And, you sort of hope one of these days he'll descend into the clouds with or without Jesus. The guy is pretty damn dangerous, and I think he misleads Trump. And now we got, a Secretary of Defense who, is right in the same wavelength. And as a result of this, and you saw the nonsense over the weekend where they all admitted they didn't have intelligence, but they thought Trump did. What kind of world is this when the Secretary of Defense is getting his intelligence from, a president who's sitting behind his Twitter keyboard? So anyway, none of this adds up to anything that you can have any confidence in terms of remaining stable. Anything could happen. Now, I am glad to see that it's cranked back. And frankly, I do recognize that Trump may be delusional about many, many things. He may be badly informed about almost everything. But the one thing he does know is that he must be reelected, because if he isn't, the new Democratic administration will hound him to all ends of the earth until they put him behind bars. And so when it comes to anything that can adversely impact his chances for reelection, he may huff and puff and threaten and as he did with his 52 sites, I think it was on Friday or Saturday, but then back off. The danger, though, is that mistakes can happen in a fraught environment like we're in today, with all the bad advice he's getting, all the bad emotional impulses that he has. So I guess we're really on eggshells here.
I have to agree completely with that sentiment, and it's something that is lost in a lot of the discussion around this is the complete lack of predictability that we have now, right? And markets hate unpredictability, and what I've seen coming into, I'm just going to shift to the markets for a second because I think it's important that we address it from that perspective, which is that markets hate uncertainty, they hate unpredictability. And look at what happened. Coming into the end of the year, we had a weakening dollar, a strengthening euro. A lot of that was probably hedge fund book squaring and whatnot. But then the minute Trump started us down this path, we started getting a strengthening dollar, and we're getting follow through of the dollar this morning. It's back into its long-term trending channel. Not that I'm a huge fan of trend channel analysis, but it's there. And we had a technical signal on the weekly chart last week. I fully expect now to see a rising dollar as everybody just starts hoarding dollars because we don't know what's coming out of the United States government next. And that is truly scary. And we already had a dollar hoarding environment. Otherwise, the Fed wouldn't be in there mucking in the repo markets every day. So this is incredibly important. And this confluence of factionalism within the U.S. government, along with the state of the markets they exist now, the fact that European politics are fracturing at every level, this is a recipe for a complete and utter collapse. Yeah. You know, when you go back, I mean, Jeff Snyder made a great point a couple of months ago, saying, you remember back in 2008. That the problems in 2008 started in the repo markets, right? Yep. While Bernanke was starting to raise rates, and then about 6 months later, Bear Stearns imploded. Now we're month 4 into this 6-month kind of reprieve. We had the yield curve invert last year. We had the repo, which then told us that foretold that the repo markets were going to seize up. Everybody was talking about recession. I'm like, when you're spending $1.3 trillion more than you're taking in, there ain't going to be no GDP recession. I got news for you. Just ain't happening. You know, you can make those numbers do whatever you want to do when you're printing and spending 1.3 trillion more than you're taking in. Sorry. So now the question is, you know, when that occurred, and the very few analysts that got it right understand where we are in this cycle, and the political instability is going to continue fueling this, and at some point it's going to fuel it to a point where the central banks can't control it, and that I think has actually been communicated to Trump, believe it or not.
Yeah.
And well, and the reason and the prima facie evidence for this, David, and I'll let you. And then my last point is that he's going to cut this phase 1 trade deal with China, which doesn't solve anything, and actually doesn't change anything, to be honest with you. And he's doing so because he was told to back off on this, otherwise he's going to crash the world economy.
Yeah, well, you know, there's so many things to unpack here because.
There's so many angles to look at this. Absolutely.
Yeah. Okay. Let's start with the trade deal. I mean, this is really a nothing burger that essentially doesn't even restore the status quo ante. I know there was $24 billion worth of ag exports to China in 2016 before Trump got started, making everything better. He drove it all the way up. Not up, down to $8 billion in the year just ended, and I think at an annual rate it's running at least even less than that. Now, even if you go back to 2013, 2012, at the peak of the so-called recovery boom, particularly in China, they were importing $28 billion a year worth of ag stuff, feed, grains, meats, all the rest of it from the United States. We're not even going to get remotely back to that because we put Brazil in business and Argentina in business. On the other hand, a lot of U.S. exports have simply been redirected to markets Europe and elsewhere that Brazil vacated in order to ship to China because obviously China has very high tariffs on U.S. ag imports right now. And it's just, and what I'm saying is it's just totally reshuffled for no rational reason the entire ag trade of the world economy. So now he comes in with a deal that's going to be really hard because the Chinese are saying, well, one, we have to, observe, the rules of world trade, whether they do or not is another matter. And we can't give a preference to U.S. exports. They can lower their tariffs against the U.S. and level the playing field, which they will. But still, unless they go outright into state-directed procurement for their entire agricultural economy, you're not going to get close to 50 billion. This is nonsense. So it's just a kind of tourniquet that he put on the bleeding, at least to try to convince the market for a few weeks or months that some great conflagration in the global trade and with China has been avoided. But I think it's only going to be a matter of time until everybody realizes there's nothing to this. The real issues haven't been addressed. And we're back in the soup. That's the first thing. The second thing is on the stock market, after 10 years of this kind of central bank policy and constant injection of liquidity and cheap, Fed-generated credit every time the market hesitates or even attempts a modest correction, 5 or 10%, and especially last Christmas, a year ago, when it hit 19.9% and really was, in danger of going into deep correction territory. It's always bounce back. And so the impulse, let's say the muscle memory in the market, because that's all it is. These are machines and day traders. The muscle memory says buy the dip, so they keep buying the dip. So you have a stock market that is utterly unreliable, incapable of discounting anything except the next, when is the next injection coming from the Fed or other central banks. On the other hand, you have central banks, particularly the Fed, in charge of the monetary system, and now literally almost fanatically committed to pegging interest rates at any cost, come hell or high water. And that's what I think this whole repo ruction, so to speak, has been about since last September. The Fed has decreed this late in the cycle, with the Treasury flooding the market with new paper, just between June, and this was partly the underlying deficit trend, but also the timing, because once they lifted the debt ceiling, then the Treasury went to town replenishing its depleted cash balance on top of the running borrowing requirement just because of the spending revenue gap. But in any event, they borrowed something like $900 billion between June 30th, and I'm just talking about last year, not years ago, but last summer, and the present. So all that paper came flooding into the bond pits. And on top of that, when the Fed signaled that they were, abandoning everything they had promised as of last December in terms of normalization, in terms of QT and shrinking the balance sheet, and then when they went into outright rate reduction, I mean, it was just a signal to the market to start front running the Fed and buying what they're going to be buying, which is government securities on leverage. And so there was a tremendous amount of financial engineering going on, a tremendous amount of repo-based speculation in Treasury debt on top of the new demand for new paper from the U.S. Treasury itself. And so obviously what that did was drive up the market clearing rate in the overnight and short-term markets. And, the Fed is committed to keeping the funds rate at an exact low, peg that makes no sense. Right now it's 1.55%, when any decent measure of inflation shows that it's over 2. In fact, I like the CPI 16% trim mean CPI because it is a pretty stable measure of the market basket that's in the CPI, as imperfect as it is. But in any event, that's at 2.35%. So we're running 80 basis points of negative interest rate right now. And yet the Fed is, which is impossible to sustain, I think, when you look at the supply-demand balance, but the Fed is so committed to it that when yields start to rise, as they did in the repo market, which is much bigger, trillions in the repo market, 70 billion only in the federal funds market, which isn't even a market anymore. It trades by appointment. It's basically federal home loan banks trading with each other for reasons I don't even know why it makes sense or is important. But in any event, when pressures began to drive interest rates up, the Fed flooded the market with what became something like a 400 billion expansion of its balance sheet, 127 months into an expansion cycle, in total, contradiction to what any logical thing would tell you to do and what they were actually saying as recently as a year ago, December. So this is just fueled the last surge of, irrational exuberance 2.0. It's very similar, in my view, and I had some data I published recently on this, to the Y2K surge that occurred from September 99 to January, February 2000, again, for no good reason except the Fed wanted to keep the party going. And then, of course, you hit the peak in March 27, 2000, and the market's down 33% in 14 days and 80% over the next 2 years. I think that's where we are right now. I think the Fed's stupid response to a market desperately trying to find a yield that cleared supply and demand last September, October, November, this response, flooding the market with repo, and then this treasury, 60 billion a month of treasury purchase. All of this is, fueled the monetary kerosene right down there into the canyons of Wall Street that have taken the market, as we've seen in the last few weeks, to these absurd heights. And it's just a matter of time before the last mullet is found and the last, bid is satisfied, and then we're going to have a big unwinding. And it's going to come at a very bad time, right in the middle of an election that is now going to be bitterly contested by two parties that no longer believe, they no longer believe in the legitimacy of the outcome of the process. That's what the Democrats have been doing with Russiagate and Ukrainegate, and now this idiotic impeachment thing. And frankly, that's what Trump is going to be suggesting as you get closer to the election about, all kinds of illegal aliens voting 16 times on buses that are shuffling.
Right.
I mean, some of this actually happens, but the point is, I don't think, and I've been watching this for 50 years. I started in Capitol Hill in 1970. I don't remember any time where there was this kind of fundamental partisan viewpoint deeply embedded in the rank and file of both parties, that the elections are being manipulated by the other side. And if we get to that point next November, in the midst of a stock market that has crashed and an economy that's in trouble because recessions are caused by crashing stock markets, not vice versa in the present age of Keynesian central banking, I think we got some heavy weather ahead. I call it the turbulent 20s coming down the road, and it ain't going to be like the roaring 20s a century ago, for sure.
No, I don't think so. And I want to take this even one step further, which is to say that we have a bigger problem in Europe. And by the way, I can hear your I hear myself in the speaker locally. I'm not sure what that is, but we have a bigger problem in Europe, right? You've got all of this happening. There's a massive dollar demand out there that has nothing. I almost believe has nothing to do with the United States proper. That um, that uh, we have a regulatory mismatch between the European banking system and the American banking system, which I think is fueling the lack of trust between American banks and European banks to actually clear the short-term markets, right? And so the Fed is having to come in and be the lender of last resort through the repo markets in order to keep the overnight funding markets full, and the Treasury's printing money like is spending money like mad in order to keep the dollar demand high enough that we can that the dollar doesn't rise, because no one wants to see a rise in the dollar, and the dollar is beginning to rise, and that's what I think is going to ultimately undermine the stock market, is going to be this rise in the dollar, while at the same time we're seeing deflation in oil. Notice how oil can't seem to catch a bid,
Right.
even in the midst of all of this war, right? It catches a $2 bid and then we back off, and then all of a sudden it collapses again. And I've been detailing this for my patrons for months now, saying, look at the weekly chart of Brent crude. It is the most obviously manipulated market I've ever seen. And I've been following gold literally daily for the last 20 years, right? And I look at that as a technical analyst, and I just look at myself and I go, who is manipulating these headlines in oil to try and keep these prices higher? And I can tell you there's two people. There's the Saudis who need higher oil prices, and the United States frackers, as you and I have well discussed last year, right? That
Yep.
the fracking industry here in the U.S. that Trump is all very proud of, because it's helping to fuel oil exports by keeping the Brent WTI spread high, about $5. Brent trades at about $5
Right.
as a premium to WTI. They're flaring off so much gas in the Permian Basin that they can't even sell it. Right? They're producing so much gas. They're generating hundreds of billions of dollars in negative free cash flow. So these are the two markets that desperately need a higher oil price above $65, $70, and they can't get it. And so we have that. We have a stock market that's overvalued. I think it's overvalued partly on all the things you talked about. Embedded in your comments were this: the stock market is still the Dow. If you look at like DIA, right,
Mm.
the Dow ETF, it's got a 2.1% yield at these prices. So
Right.
hell, that looks good to me. Like if I'm just a rank and file everyday family office guy, I'm looking. Do I buy a 2-year Treasury at negative 85 basis points real yield, or do I buy DIA at -6? And if I'm a European family office who's really worried about the euro collapsing, which it has been, then that real yield on the Dow is even higher, because remember, the euro collapsed from $1.25 to $1.11 last year. It has no strength whatsoever. And with the things that are happening in France, with Brexit going through, with all of these things happening, and with Trump being openly belligerent to European economic imperatives in every way, you tell me that political stability in Europe is going to fuel a rising euro at this point? No way. The rising dollar is going to cut the euro is the most vulnerable major currency to a rising dollar here. And that's going to send a tremendous wave of capital into the US, regardless of the fact that the Dow, by any historical metric, is overvalued. The NASDAQ is insane. What in the hell is Tesla doing trading at $500
Yeah.
a share, right?
Yeah. Or
Take that.
what
That
is what is Apple doing? Doubling in price in less than a year, gaining a $500 billion of market cap in about 12 months, when its operating earnings are essentially flat. Yes, it's the greatest company in modern times, the greatest thing since sliced bread. But why is it trading at 28 times earnings and like 40 times free cash flow? It
Well,
doesn't make
you know,
in other words, when you get near the end of a cycle,
sure.
what happens every time, this is proven historically, the markets get narrower and narrower, and all the speculators and now the machines and the day traders and the robos jump on whatever's going up, and there are fewer and fewer things going up. In fact, about 20% of the gain last year in the S&P 500 was in 5 stocks. So these are all signs that the system is unstable. What you're talking about is just, I think, one more sign that the world today is in the throes, let's say, of central banks of a monetary system that is completely irrational and unsustainable and unstable. When you look at Europe and you wonder why all those European bids are coming towards dollar securities, both debt and equities, consider the fact that the idiots at the ECB have driven yields so low throughout not just the sovereign sector in Europe, but the corporate sector and the junk sector as well. Last time I checked, about 30% of European junk bonds were trading at zero or even negative yields. And when you get to the point and you say the word out loud, sub-zero junk bond yields, you don't even have to say anymore, right?
Well, you do if you're talking to a layman, but if you're talking to anybody who's even a remote market journeyman knows that sub-zero drones should be an oxymoron, right?
Yep.
And yeah, no, you're absolutely right. And when you look at it and you think about what's happening, and again, I've been watching like German 2 years, German 5 years, been watching that carefully because those markets are turning around at this point. So for so long now, you're talking about the robo monkeys or the Momo monkeys. They've been front running the ECB for years, driving yields negative, and that trade is beginning to turn. And I think the ECB is trying to hold current levels on all of these charts. If you look technically on all of these charts, they're all like right on the verge of a breakout in yields, which would be a breakdown in price, and that would then fuel even more of a rotation out of the assets. And they're the most overvalued assets in the world, as bad as the Dow is. And don't get me wrong, I'm still a Dow bull, at least for the next couple of months. Not today or tomorrow, but certainly right around, March or into early Q2. I think we're going to see in the Dow as the dollar starts to spike because Europe is going to let loose first. And then fuel even more political instability and everything else. And God's forbid that a jackass like Pompeo tries to gin up a war with Iran. That's only going to fuel the Chinese finger trap of a push higher and dollar hoarding, destroying what's left of the capital markets because it's a deflationary environment. And the Fed, rightly, in some ways, rightly, is trying to keep the dollar funding markets from imploding, from seizing up, because they don't have any other option. Because the other option is, oh, well, we're revealed to be the emperor naked with no clothes, swimming out there naked, and then the tide's going out, right?
Yeah,
they can't do that.
I think I agree with that in terms of where it's going, but I think in some ways it almost gives them too much credit. I don't
That's true.
They realize how close to the edge the entire system is. They never do. They've never seen it coming for decades and decades. But right now, they're so mechanically. Listen to this. The guy they put in charge of the New York Fed, and it's mechanical, paint by the numbers, interest rate control. And so therefore, this idea that you peg the interest rate really through the IOER, the interest on excess reserves, and to make sure that that works, you flood the system with far more reserves than make any sense whatsoever. That doesn't even evince, in my view, a kind of prudential view of the fragility of the global monetary system. I think it's just more mechanical, paint by the numbers stupidity. And they want to drive. In other words, they command the short-term rate, the overnight rate, to be 1.55% right now. They have a range of 25 basis points, but they're commanding 1.55% right now. And if it takes unlimited amount of repo or not QE to make that happen, that's what they're going to do. Absolutely. And it may stave off the day of reckoning for a few weeks or months, but it's just ensuring that the ultimate eruption of this thing will be all the more traumatic. And unfortunately, it's causing all the central banks of the rest of the central banks of the world to do the same thing or even more. The disease, in a sense, has become universal. And I go to your point about the D-mark. I noticed the other day, not the D-mark, I mean the German bonds. Maybe we'll be back to the D-mark shortly when this blows.
Maybe.
The 30-year issued, I think, sometime last spring, is already down 14%. In other words, the people who bought that thing at a slightly negative yield are now 14% underwater. And the point is, you know, how many times does the mule need to be clubbed between the eyes before they wake up and they say, you know, the front running game is over? I agree with you completely. That's been going on for almost a decade in Europe. But once they decide the front running game is over, the only reason anybody ever held Subzero sovereigns, or we're still, what, you remember a couple months ago, the Austrians issued a 100-year bond at a negative, effective yield in the market. The only reason people bought that was because it was appreciating. There was so much front running, there was so much bond buying by the ECB that prices were going to go up. So you bought it because it was, it was acting like a stock. The price was going up, not because you thought it was a rational thing to buy a negative yield. But the question, of course, always is, well, when does the music stop? When does Chuck Prince, make his reprise? It's in all of these markets, we have these circumstances. The Italian debt market is the same way. The Greek debt market is ridiculous. So all around the world, you have these markets that are being completely distorted and, infested with irrationality. And once they get out of hand, and I don't think the central banks can control this much longer, there's going to be hell to pay, as far as I can tell.
Yeah, no, I agree completely that they're going to lose control of this. That's what this whole next phase of the cycle is about. It's the repudiation of the central banks as the great wizards, right?
And 2008, by the way, that is exactly the reason to own gold, to tell you.
Absolutely. Absolutely. Oh my God, yes.
Not that gold is an inflation hedge, as we used to say. It's a hedge against the ultimate collapse of Keynesian central banking as it's being practiced today by the Fed and all the other central banks of the world, including the central bank of the Red Ponzi. That's the reason to own it.
And the lack of political stability at an institutional level. I mean, look, at this point, you should be owning gold because Nancy Pelosi is crazy. You should be owning gold at this point because Emmanuel Macron is going to push for fiscal integration of the European Union, okay, in order to try and convert all of that negative yielding sovereign debt into Eurobonds, okay?
You should be owning gold right now because Pompeo is Secretary of State. And he is bound and determined, and there's a whole phalanx of them, to get a war started with the Iranians or to force a collapse of the regime. And frankly, what they never, ever, ever learn is the regime is not going to go quietly into the good night. If you push it against the wall far enough, and this insane set of sanctions and embargo on their oil industry, it's a whole different topic we didn't get into, is simply an invitation for at some point the entire Persian Gulf to explode. And I've been publishing these maps, everybody's putting them out now, but you look around the Persian Gulf and you say, the Iranians are asking for it. They put their country right in the middle of 35 American bases and 50,000 American troops. Okay. Well, that was a tinderbox from the beginning. That's what Trump inherited. He should have been finding ways to dismantle that structure, which is, one, dangerous, and second, nothing to do with national security, peace in the region, or anything else. But what he's done is populated his government with people who want to take it, to the ultimate last step, which is to blow up Iran. So, all
It's
these
crazy.
things are out there, and they tell me that there's no safe place to hide in the traded financial markets unless, you're trading by the hour and the nanosecond and don't sleep at night except with one eye open.
Right. It's
It's
funny, and I'm going to give Trump a little bit of credit, or at least a little bit of understanding of what the situation is, which is that he's been boxed in at every level. That there's no one who willing to go even work for him. Right
Yeah,
after he threw Mike Flynn under the bus, that was the point of getting rid of Mike Flynn, because at that point, no one decent would ever go to work for him, and his advisors around him were all handing him neocons. The Senate was absolutely signaling at every level, we're only going to uh, approve these types of people. We had the story from the Wall Street Journal over the weekend that Trump is dealing with sincere traders within the GOP, saying that if you don't start a war with Iran, we're going to impeach you simply because it's a political process. I've
yeah,
been saying since the day Pelosi announced that she would start the impeachment process that Trump is now 17 votes in the Senate away from being removed from office because it's a political process and not a legal one. The charges are sham. The charges are a sham. It's all ridiculous. And again, I get vindicated every time I see this stuff, and I hate to like bust my hand, pat myself on the back, but you got to remember who these people are. If you remember who these people are, how freaking horrible they are,
yeah,
and what
yeah,
their actual agenda is, it's pretty
yeah,
easy to see that all that Trump is boxed in here because Lindsey Graham says, "Look, dude, if you don't like go to war with Iran, we're going to just remove you from office and put Pence in charge."
yeah,
Like,
yeah,
because we can do that. Because Pelosi just threw together, some garbage, put a candle on it, called it a cake, and said, "Hey, eat it."
yeah. Well, that's a thing that's really troubling here,
Hmm.
and that is that Trump, in many ways, despite those good impulses that we talked about in the campaign that he ran, is a hostage to the neocon
Sure.
phalanx that controls the Republican Senate. And when you think about it, Lindsey Graham, Rubio, Cotton,
Hmm.
you could go name the rest of them. These people are out of their minds.
Yeah. Yeah.
And yet they basically determine, what the parameters are of what we can do and can't do. And it's not leading to a good ending, that's for sure.
No, it really isn't, and it's something that we all have to be extremely worried about going forward. I'll be honest with you, the silver lining to the neoconservatives control of our foreign policy comes in the form of, and this is, I think, what Russia, Iran, and China have been doing in terms of how they've been playing us on the world stage at a geopolitical level, how they've managed every one of these confrontations, which is I firmly believe that they're setting up a massive, allow the neocons to overcommit themselves, allow a kind of a classic trap maneuver in chess, since the Persians
Yeah,
invented chess,
yeah,
and Putin is a judo master. Never forget these things, and
yeah,
probably the greatest geopolitical judo master of all time, is suckering us into a massive overcommitment to Iranian regime change, and then they're going to reverse us once the capital markets reverse, and they're going to hit us where we are most vulnerable, which is in the capital markets. We're not vulnerable militarily in any way that matters. Yes, the Iranians can do damage to us that we're not, that politically no one wants to bear. But the truth of the matter is that if the Iranians kill an American or 5 Americans that Trump's willing to admit to, forget it. The
sure.
United States will go crazy, and we can glass them, and that'll be the end of it, right? It's that's what's going to happen. So the bigger problem here is, and I think everybody involved in this understands this. I think that's why Iran came clean on the shoot down of
Sure.
the airliner, which is to show themselves that they're willing to work with the international community. Um, Even though I have doubts as to how that plane actually got killed, right?
Yeah.
Got hit. I have sincere doubts about it, but I'm willing to accept the official story. So all of these things, I think, there's the geopolitical war of attrition waiting for that right moment to lean on the capital markets in such a way as to cause maximal damage. And that's what we should be watching for as a geopolitical trigger for the catalyst of the next financial crisis that's on the horizon. And your clues, in my mind, are in oil. They're in the short to medium to the belly of the German and French yield curves, and they're in the dollar index. And I think if you keep it there, maybe watch the euro. I think if you look at those markets, I think it'll be pretty obvious. Everything else is, I think, a secondary effect of that. The Dow rising to 35,000 before it crashes or whatever. That's fine. I think all those are secondary effects. I think these are the primary root cause analysis markets. So if we watch those and maybe a few others, we'll be able to figure all this stuff out and get the right signals. I don't know if you want final thoughts on that before.
Yeah, well,
cut this off.
I agree with that completely. And since we just passed another Jobs Friday, I'm reminded of the fact that those indicators that you just named, let's say the belly of the yield curve on the German debt as being important, remind you also that totally unimportant, irrelevant is the U3 unemployment rate that everybody's crowing about,
Right.
or the number of jobs confected by the BLS per month, which get dramatically and drastically revised over time anyway, as a indicator of how we're in a good place, as the Fed heads keep saying, or that we're in the greatest economy ever, as the Donald keeps boasting. That's beside the point. That's a sideshow. That's irrelevant.
Exactly.
When you look at the monetary and financial disorder and instability that's been impregnated into the global system. And so you need to watch those key financial inflection points. And, I think you'll see it coming at least before the rest of the herd. But I still think we're not out of the woods by any means in the Persian Gulf, because this policy of maximum pressure, of bringing the Iranians to their knees, the sanctions, which Washington has now gotten so used to, they comfort themselves in saying, well, this is an alternative to war. See how, what great statesmen we are. No, this is just economic warfare. This is war by another means.
Yes.
And what Washington doesn't get, because it's now an imperial city that attempts to run the world and has a standard that applies to itself and no one else, that we are conducting war against the Iranians in a situation where they can't harm the homeland, never could. That's why we didn't need the war in the first place. There's never been any Iranian-sponsored or Shia acts of terrorism in all of North America. It's all been Sunni jihadism coming from the other side of the divide. But my point is, the only thing they can strike back at are the 35 bases and the 50,000 troops that surround them that shouldn't be there in the first place. And when push comes to shove, either by accident or by miscalculation, there's going to be harm to American personnel, and then what you just alluded to is likely to happen. Big one in the Persian Gulf, and then everything's off.
Everything changes at that point.
If the Persian Gulf blows up and oil hits $250 a barrel, in these markets that are up in the nosebleed section of history in terms of PE ratios and everything else, all of these accumulated financial imbalances will come unwound very fast, and the central banks don't even begin to have the ammunition to deal with it, in my judgment.
No way. I have 3 words for you: interest rate derivatives, or 4 words: interest rate derivative swaps. Yeah. Right. That's all. I mean, and I can follow up with 2 more words: Deutsche Bank. So, David, it's been an absolute joy and an absolute honor to chat with you for the last close to 45 minutes now. I think that's good, and I think this is a great way to start the post.
To start the new decade.
Well, and the post first phase of confrontation, and so I think that's where we are. So I appreciate your time and everything else. You have a great day, and we'll talk again soon. I hope so.
Okay, we certainly will. Great.
Take care. Bye-bye. Thank you all for tuning in to the Gold, Goats, and Guns podcast for Tuesday, January 14th, 2020. I hope you all enjoyed it. Remember, you can follow my work over at tomluongo.me. You can follow me on Twitter at TFL1728. You can also support my Patreon over at patreon.com/Gold, Goats, and Guns, where I do twice weekly video market reports on Wednesdays and Sundays, as well as publish a monthly investment newsletter. And lastly, you can share this podcast with those you think would enjoy it. So if you would do all those things, follow it on iTunes, Spotify, whatever, that would all be great. You guys take care. You have a great day, and we will talk soon. Keep your stick on the ice.